This is Bloomberg Daybreak Middle East and Africa. Our top stories this morning. The US stocks party rolls on. The S&P 500 and Nasdaq 100 hitting fresh highs on hopes for a soft landing and after a surprise rate cut in Switzerland. Stocks in Asia broadly retreating today. A top Israeli official says the military will invade Rafah in Gaza no matter what the US says. This ahead of a delegation to Washington next week. Plus, with the UAE now the world's biggest foreign investor in Africa, we'll discuss what it means for the continent and for the Middle East. It's just gone 8 a.m. across the Emirates. I'm Lizzie Verdon in Dubai. Good morning. It's Friday. You made it. It's been a busy week for central banks and for geopolitics and for markets. You had the S&P breaking to a whole new record again for the 20th time this year yesterday. But that positivity has not carried on into the session today. The MSCI Asia Pacific Index currently lower 0.8%, though you have got Japanese equities eking out gains because of hot inflation data. And Avril Hong will tell you more about that in a moment. But you've got futures pointing to a lower opening in Europe. S&P E-minis just flat to the upside, but Nasdaq futures tilted to the downside. Why? What's not confidence? Well, let me show you. Let's flip the board to the cross-asset picture, because despite all the enthusiasm that 3 Fed cuts are coming, as confirmed in the dot plot on Wednesday, itchy fingers to cut, as Larry Summers puts it, yesterday's US economic data kind of undermined the narrative. Could the resilience in the economy mean that rates fall more slowly than the market expects? You can see the doubts creeping back in. It weighed on treasuries yesterday, the 2-year yield now at 4.61%, and the upwards pressure on yields lifting the dollar. It's also, as I say, been a busy week for geopolitics. You've got Brent there, down for a second day as traders mull the situation in Gaza, and we're going to bring you expert analysis of that later in the show. But let's get a deeper dive now on what's happening in Asia markets. Avril Hong's waiting for us in Singapore. Hey, Avril.
Hey, Lizzie. Yeah, we're seeing very little appetite for risks at the end of the week as we have a couple of things to digest, not just speedier inflation out of Japan, raising questions. Are we going to see another rate hike this year from the BOJ? Geopolitics as well. SMIC, the Chinese chip maker, in the crosshairs of U.S. authorities. They may have broken American law. And then don't forget that next week we have a couple of earnings scorecards from some of the most troubled, distressed developers in China, and we're seeing the Hang Seng Tech today accelerating those losses throughout the session, 4.3% down into the lunch break. CSI 300 Hang Seng also lower. At this level they're seeing on Hang Seng Tech is the lowest in about 2 weeks. On the Nikkei, erasing the gains from earlier on in the session of about 0.7%, and that is despite the relative weakness in the Japanese currency. Let's flip the board, because the other currency I really want to talk about is the yuan, and we've seen the offshore and onshore both roughly the weakest level in 4 months. This is on the back of the PBOC's yuan fix, which surprised and spooked traders above 710 for the first time in about 2 weeks. What does this mean potentially about the Chinese central bank letting the currency weaken? A lot for investors to digest today, Lizzie.
All right, Avril Hong in Singapore, we thank you. And I want to continue the central banking conversation because we did have some notable central bank moves overnight. We had that surprise quarter-point cut from the SNB. Bank of Mexico delivering its first quarter-point cut this cycle. Turkey and Taiwan surprising with 500 basis point and 12.5 basis point hikes respectively. So to digest it all, let's get some analysis. We can bring in Dan Moss, our Bloomberg Opinion economics columnist. Dan, great to have you with me. How much of a theme is central bank divergence going to be from here?
It's going to be considerable. Lizzie, it's interesting, the ones that you just emphasised have a reputation for being outliers. People got excited when they saw that surprise Swiss move, and it was really the only substantive surprise of the week among the major central banks. But if you delve into a little bit more, there's something there that's sui generis about Switzerland. This is a central bank that has pegged its currency without warning and unpegged its currency without warning. It's had negative interest rates. It's had positive interest rates. In that sense, you know, it's an outlier.
And just staying in Europe to the BOE, no surprise decision, a hold, but it was the first time in 19 meetings that none of the Monetary Policy Committee voted to hike. How dovish a signal was that for markets?
Yeah, this puts the BOE more in the mainstream of the developed economy central banks. Japan is an outlier. Sorry to bombard you with the outliers, but if you look at the Federal Reserve, the ECB, Bank of England, Bank of Canada, among the G7, they're all basically moving in the direction of some, not a lot, some cuts in interest rates this year. That's been the overall message. You know, the Swiss are a sort of a sexy asterisk at the end of that. But you know, this is a confirmation of the message we've seen emerging really since late last year. There will be cuts this year among the major central banks, beginning around mid-year. Will it be 2008-style severe reductions? No. Will it be 2020-style reductions? No. Maybe it'll be sort of 95 to 97 reductions. The glorious period in the mid-90s when we thought the paradigm had shifted and interest rates were just nudged a little bit this way, a little bit that way among the major central banks. That's a plausible scenario at this point.
I love it. The historical context. Dan Moss, great to have you with me. Bloomberg opinion columnist Dan Moss. I have to say, I'm usually enthralled by the Bank of England, but yesterday, even I can admit, was a bit of a nothing burger, even if we did lose two hawks. I reckon what's going to be more interesting is when we start to see more in the camp joining Swati Dhingra, voting for cuts, and then you start to think about the language around the decision as well if you're looking for excitement. Yesterday, the BOE saying that it could still be restrictive even if it's cutting rates. Maybe you would say that's not so surprising. Maybe it suggests that rates are coming down soon. But let's get some more analysis. We can bring in Majabin Zaman, who is head of FX research at ANZ. Great to have you with me. We had this dovish BOE yesterday. What do you think is the risk that the Fed lags European central banks in easing this year? And how much, Majabin, do you think that that's going to weigh on European currencies like the pound?
That's a great question. I think dollar looks to be continuing to move upwards today, especially. Look, I think quick takeaway from why the Fed was dovish. You know, at the end of the day, they are looking at the inflation numbers. We do know that, you know, obviously in January and February, inflation numbers in the U.S. Were much stronger than expectations. So why was the Fed still pretty dovish, right? So I think one thing is, you know, obviously Powell came out to say that, you know, maybe it's going to be a bumpy road. It might take time. So, you know, I think then we're watching for the next 3 or 4 inflation numbers to see how they are. If they continue to be on the upward trajectory or persistent trajectory, then maybe you delay the cuts. However, the other side of things is, you know, when the Fed or Powell is thinking about inflation, you know, it also could be that structurally they think inflation is not going to be higher. And so given the adjusted higher neutral rate, which then effectively means that, you know, if they have accepted that structurally inflation is generally going to remain high above that 2%, you know, they might then proceed with the rate cuts sooner rather than later. But bottom line is, I think the March CPI will be most important to see whether the trend in inflation uplift continues or not. And that will paint the picture forward.
And Avril mentioned Japanese CPI this morning showing inflation rising at the fastest pace in 4 months. Do you reckon it's going to be one and done for the BOJ?
Look, I think for the BOJ, we've got another rate hike priced in, but that's only in Q1 next year. And the reason for that really is because, I mean, you know, our takeaway from the most recent rate rise was that it was dovish. And dovish because BOJ will continue to maintain, you know, its purchasing of government bonds at the same pace as it has been, around 6 trillion per month. So we think that, I think with all of that, you know, given Governor Ueda continued to say that he's happy to keep financial conditions accommodative, we don't think there's going to be any immediate upside in Japanese rates, at least not this year, and we wait till next year. On the inflation front, the inflation numbers came pretty much in line, slightly below expectations, but higher than the previous month. We need to remember that a lot of Japanese inflation, because they import a lot of things, is more goods related rather than services related. And that's a good problem to have because we know goods prices globally are coming off. And so we don't think inflation from the goods side will be sort of a persistent thing. It's really the services side inflation, which we're seeing in the US, here in Australia, which tends to be sticky. And I don't see that being an issue, given that consumption is slowing in Japan.
OK, that's interesting. I want to ask you a question that I've asked Dan Moss. We often talk about this. The last thing, Mahjabeen, that any central banker wants is to have to reverse course on policy. Which central bank do you reckon is most at risk of a U-turn?
Look, I think it's hard to say. I think when we look at the Eurozone and we look at the UK, again, a lot of that is more on the good side of things, which is why in the last few months we have seen prices, or inflation rather, fall very quickly. And again, I think BOE, for example, you were talking about it earlier, while they have kind of now maybe just very slightly approaching that neutral phase, but waiting for more data, we think it's still, they still will need some time to evaluate. And that's what all the central banks have been saying. We're data dependent, waiting on data, but which also means that the next few inflation prints, whether it's the UK or it's the US, are very, very critical and will be, again, relevant for market reactions as well.
Yeah, you agree with our economists at Bloomberg Economics there. They say that the data for the BOE is there for a May cut, but they're going to sit on their hands because they don't want to necessarily go first. They want to be cautious. Just finally, we've had the SNB chief, Thomas Jordan, saying that the conflict here in the Middle East is the biggest risk to the inflation outlook. How concerned are you about that?
Look, I think the conflict so far, the results to, for example, the dollar has been pretty mixed. We did see previously what impact the Russian-Ukraine conflict had on the dollar. Yes, we saw the dollar rise then, but that was also ahead of the Fed raising rates, for example. That was along with the synchronized tightening cycle that we had. So we saw, the dollar benefit. But, we've looked at various other conflicts, for example, the 9/11, the Lebanon war, that saw a flat DXY. And then obviously the Arab Spring and the Gulf War saw a lower dollar. So in isolation, you could argue that, yes, if there is, a significant more, bigger impact from the existing conflict, safe haven flows traditionally flow to the dollar. But last year, we actually saw safe haven flows rather move to the Swizzy rather than the dollar. So we didn't really see a direct benefit in the dollar on the back of that. I think the bigger risk would be, to your comment, would be oil prices. If oil prices continue to rally as they have more recently, again, that probably will have some direct impact in a stronger dollar in the near term if oil prices continue moving upwards.
Mahjabeen Zaban, Head of FX Research at ANZ. Great to have you on the programme, thank you. And we're going to dig deeper into the geopolitics next. Hear why Rain says neither Hamas nor Israel is prepared to budge on the core issues plaguing the conflict in the Middle East. But up next, a closer look at the war after a top Israeli official says the military will ultimately invade the southern city in Gaza of Rafah. Stay with us for that. This is Bloomberg. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Lizzie Burden in Dubai. A top Israeli official says his country is ultimately going to invade Rafah no matter what the US says. The defiant warning was sounded during US Secretary of State Antony Blinken's visit to the region as he seeks a deal between Israel and Hamas.
There's a clear consensus around a number of shared priorities. First, the need for an immediate, sustained ceasefire with the release of hostages. Negotiators continue to work. The gaps are narrowing, and we're continuing to push for an agreement in Doha. There's still difficult work, to get there, but I continue to believe it's possible.
OK, let's get the latest on this week of diplomatic wrangling. We've got our Dubai Bureau Chief, Donna Kraish, with me now. Donna, what's the state of the US-Israel relationship as we end the week?
Still strained, as we have seen this top Israeli official, a minister, saying that Israel will go into Rafah regardless of what the U.S. says or what the world says. It's kind of pitting Israel against the war in this Rafah operation. But Blinken also in the region this week, and from Cairo, he said that he repeated what the U.S. president said about, going into Rafah would be a mistake. And he said a major military operation there is something that the U.S. doesn't support. And it's also not necessary to deal with Hamas, which is necessary at the same time. And we know that an Israeli delegation will be in the U.S. next week to discuss possible alternatives to the Rafah operation. And, at this moment, it's kind of hard to imagine what alternatives would Israel agree to.
And what's the latest on the hostage deal?
Yes, so Blinken's visit in the region, like we were saying, could be seen as more of a push for these negotiations that are continuing in Qatar. The U.S., Qatar, and Egypt are mediating to reach an agreement. Potentially a 6-week ceasefire that would allow for the mass entry of humanitarian aid into Gaza. We haven't yet seen any positive signs, but Blinken did repeat that he was positive and that there were some gaps remain, and also said that it was difficult, but basically doable. Blinken also met with the foreign ministers of Egypt, Jordan, Qatar, Saudi Arabia, the UAE, as well as an official from the Palestinian Liberation Authority, which is the recognized government of the Palestinians. They spoke about post-war Gaza plans and the increase of humanitarian aid via air, land, and sea.
And meanwhile, significantly for trade, you've seen the Houthis telling China and Russia that their ships won't be targeted when they go through the Red Sea and the Gulf of Aden. I wonder what that says about the balance of power on the seas.
It says a lot, actually, because it's kind of distancing these two countries from the conflict that's going on in Gaza. They've been somewhat neutral about it, and that's opposed to what the U.S. and the U.K. and the rest of the Europe and what the Houthis are actually targeting. So they are still targeting the ships going into the Red Sea, and they're saying some of these ships are linked to Israel, U.S. or U.K. We're still seeing attacks from the Houthis, and of course retaliation from the U.S. warships in the Red Sea as well.
Which points the eye back to Iran, of course. Donna Kraish, Bloomberg's Dubai Bureau Chief, great to have you on with me. And we're going to get even more analysis on Israel's war strategy later in the programme. We'll be speaking to Rain Risk Intelligence. So stay with us for that conversation. This is Bloomberg. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Lizzie Burden in Dubai. Apple shares slid 4% yesterday, erasing more than $110 billion in market value. This after the US Justice Department laid out its antitrust case against the iPhone maker.
We allege that Apple has employed a strategy that relies on exclusionary, anti-competitive conduct that hurts both consumers and developers. For consumers, that has meant fewer choices, higher prices and fees, lower quality smartphones, apps, and accessories, and less innovation from Apple and its competitors.
But the headaches don't stop on that side of the Atlantic. Bloomberg's also learnt that Apple, along with Alphabet's Google, is set to face a full-blown EU investigation into compliance with a new law reining in the power of big tech. We understand the European Commission is set to announce probes into App Store rules under its Digital Markets Act in the coming days. The move could pave the way for potentially hefty fines. Elsewhere in tech news, Micron posts its biggest gain in more than 12 years after a surprisingly strong sales forecast driven by demand for AI hardware. Its CEO, Sanjay Mehrotra, exclusively told us that the semiconductor industry is looking at a multi-year opportunity enabled by AI.
Our recovery is really driven by a demand related to AI with tight supply and actually demand that is strong across most of our end markets, particularly data center driven demand. And Micron has a strong portfolio of products. Very excited about our latest offering of HBM3E that you referred to earlier. We have just begun shipments of this, and we see strong growth in the several quarters that are ahead of us. And supply is tight. Leading edge nodes in particular are in tight supply. That's leading to price increases as well. So as we look ahead at 2024, our year of recovery, we see increasing prices driven by the demand supply fundamentals. And we look at 2025 to be a record year for Micron's revenue with significantly improved profitability as well.
2025 supply also mostly already allocated. You sold out on 2024, Sanjay. Just let's dig in on the high bandwidth memory, because what was it, Jason Huang over at NVIDIA calling this a technology miracle. Will it not get commoditized? Will prices remain elevated?
First of all, it's our HBM product that is sold out for calendar year 24, and vast majority of the supply for our 2025 is allocated as well. This is a critical product. HBM3E is in very, very early stages here, and it's key enabler of what AI platforms, generative AI platforms, are able to do. Just think about it. I mean, the latest Blackwell platform that has been announced, it has 64 die of memory in it. So tremendous amount of silicon. HBM is growing fast, expected to be about 15%, high teens, mid to high teens of the industry revenue over the course of next several years, compared to being just half of that last year.
This has been Daybreak Middle East and Africa. Our top stories this morning. The US stocks party rolls on. The S&P 500 and Nasdaq 100 hitting fresh highs on hopes for soft landing and after a surprise rate cut in Switzerland. Stocks in Asia broadly retreating today. A top Israeli official says the military will invade Rafah in Gaza no matter what the US says. This ahead of a delegation to Washington next week. Plus, the UAE is now the world's biggest foreign investor in Africa. We'll discuss what it means for the continent and for the Middle East. A very good morning. It's just gone 8:30 a.m. across the Emirates. I'm Lizzie Burden in Dubai. Welcome to Friday. It's been a busy week, hasn't it? Definitely for central banks, but also for markets. Yesterday, you saw the S&P hitting a fresh high for the 20th time so far this year, but the risk-on mood not really continuing into the session today. The MSCI Asia Pacific Index now down 0.7%, though Japan has been managing to eke out some gains because of the hot inflation data, and Avril Hong will tell you more about that in a moment. But European futures pointing to a lower opening. US futures flat to the upside. Maybe we'll see a bit more optimism later. But what's knocked confidence? Let's flip over to the cross-asset picture and I can tell you. Because despite all of the enthusiasm we saw for Fed cuts coming, as confirmed in the dot plot on Wednesday, 3 cuts in the pipeline, itchy fingers to cut, as Larry Summers put it. Yesterday's US economic data kind of undermined the narrative. Could the resilience in the economy mean that rates fall more slowly than the market expects? You can see the doubts creeping back in. The US 2-year Treasury yield currently at 4.6%. It got weighed on Treasuries yesterday, and the upward pressure on yields lifting the dollar. It's also been a busy week for geopolitics. You've got Brent here down for a second day as traders mull the situation that we've been discussing in Gaza. and we're going to continue our analysis of the geopolitical situation throughout the programme. But I want to get back to Asia now. Avril Hong's on standby for us in our Singapore studio. Avril, what's happening where you are?
Yeah, Lizzie, it's been a big week for central bank action and central bank upsets. And today we're getting one in the form of the Chinese PBOC, not from a rate decision, but from the yuan fix, above 710 for the first time in 2 weeks. Traders were clearly not positioned for this, and we see the renminbi, both onshore, offshore, weaken to levels we haven't seen in 4 months. And we are also seeing today the Korean won, the Thai baht, the biggest losers against the greenback. Now, it's not just the dollar story for these Asian currencies. It's also their sensitivity to what we see on the onshore yuan. Indeed, as Mary Nicola points out in the MLive blog, if you take a look at the 10-day rolling beta, they seem more sensitive to the onshore yuan versus the dollar index. Let's flip the board, because since we're talking currencies, let's talk about the yen. We're seeing how it's still hovering above the 151 level against the greenback. Relative weakness. Remember, it's always been about the yield gap. Today, we did get speedier inflation numbers out of Japan. That's raising some concerns that we're going to see another hike from the BOJ later in the year. A survey pushed out by Bloomberg shows economists actually see that happening before October. Regardless, it's been a really historic week for the Japanese central bank, Lizzie.
Avril Hong in Singapore, thank you. And we can stay on Japan now, because the BOJ's move to scrap the world's last negative interest rate this week signals that confidence that economic stagnation is ending. And our Bloomberg Originals correspondent Kurumi Mori had been taking a look back at Japan's money experiment.
Imagine a place where everything money-related is frozen in time for almost 3 decades. Your salary doesn't budge, the price of your unagi bowl doesn't change, and the interest rate on your home mortgage is closer to 0. Well, that was the reality here in Japan. We were used to the price of everything staying pretty much the same.
When you compare us to other countries, it's like we've been left behind.
But it wasn't always like this. At one point, the economy was growing so fast that it looked like it was about to overtake the US as the world's biggest. Then, the bust came. In the first of its shock moves, the BOJ sharply raised interest rates in 1989, trying to curb speculation and rein in inflation. From there, stagnation became the new norm. Japan has been ground zero for some of the biggest experiments in economics, from moving interest rates up and down to inventing the YCC monetary policy, among others. Now, Japan's central bank has decided it's time to end these experiments and exit negative interest rates. Raising the interest rate from negative 0.1% to a range of 0 to 0.1% doesn't seem like much, but it does put Japan back in line with other economies. If Japan's negative rates experiment ends, what now? And how is this massive shift going to disrupt everyday lives across the country and beyond?
And you can watch that full documentary on the terminal and our website, Bloomberg.com. It's also on YouTube and our official social media pages. Now, let's get back to the Middle East and Africa, because in pursuit of geopolitical clout, the UAE is pledging more investment in Africa's economies as they strive to outdo established players like China, France and the US. And we can get more now from Bloomberg's Zainab Fatah, who joins me here in Dubai, and Ondira Oganga joining us from Kigali. Ondira, just walk us through the investment in Africa and the growing confidence, the economic and political influence.
Let's start with the most recent, where the UAE came in and literally saved Egypt, which was on the brink of collapse, through a $35 billion bailout package. And to contextualize this, it's a lot of money. It is almost 11 times what Egypt was initially asking for from the IMF, $3 billion, and it's 7% the annual economic output of the UAE. And the UAE has also come in to bail out countries like Ethiopia, Sudan, and signed investment treaties down south in DRC, Zambia, and Zimbabwe. Now, I like that you mentioned politics, because there is also growing influence there. We've seen them back Ethiopia's Prime Minister Abiy Ahmed against the Tigrayan rebels, and there have also been allegations from the UN that they're supporting the RSF in Sudan, allegations that the UAE denies. On the investment front, we are seeing UAE-based companies look at developed economies on the African continent where the economy is growing. They have developed infrastructure, and hence there's a need for energy. These countries include South Africa, Kenya, Morocco, and Egypt.
And Zainab, what sectors is the UAE focused on in Africa, and why has it picked them?
The UAE is focused mostly on sectors they see essential and tie in with areas where they excel at. So they're starting with renewable energy, logistics, trade, and into that ties into Dubai ports and its presence across most of African countries right now. It's all about building up logistical networks that kind of, in a way, render the UAE a gateway for any investor who wants to do work and wants to get into these industries that they see in need of massive developments, including, ones I didn't mention, like real estate and agriculture. The agricultural part is for the UAE's food security, but also they can see that they can add value by existing trade routes to other countries.
Yeah, of course, when it comes to African ports, the trade opportunity is partly created by the situation here in the Middle East, with all that trade being diverted. Andira, just walk us through the leaderboard here. How does the UAE compare and contrast with, say, China and the US on the continent?
Just tying into what Zainab says, if you look at the areas that the UAE is interested in investing in, they're capital-intensive areas, and this explains why they're leading that board in foreign direct investment. In 2022, they pledged a whopping $52 billion, and this is 20 times what China did and 7 times what America did. Come 2023, again, $44 billion, twice what China did, and China comes in a distant second, followed by France, UK, and then the US. We've also seen them investing in areas that are competing with countries like China. China is also very keen on putting money in infrastructure, with one of their flagship projects being the Belt and Road Initiative, a direction that America is also going into infrastructure, with their flagship project being the Lobito Corridor all through Zambia.
OK, really interesting. And obviously they reckon there's money to be made here. But what are the other motivations for the UAE, Zainab?
Well, for the UAE, it really differs by location. When it comes to the case of Egypt, Egypt is an extremely important country for the region, because it's the most populous Arab country, and it's one that they see an economic implosion there could lead to ruptures politically across the region. They do remember what happened in the Arab Spring in 2011, and how regime after regime across the Arab region started falling and led to a lot of instability. So the stability, the political stability and economic stability of Egypt is really paramount to them, and that's kind of the main reason when it comes to Egypt. But when you look at other countries like the sub-Saharan region of Africa, there they see the need to develop more of the economy there, because it's closer to them. One of the things that were mentioned to me by UAE businessmen, this region is important because also instability there, underdevelopment there, would give rise to terror groups and more revolutions and so on. And we don't want that across the region. They see that they see the Chinese retreating a bit, and the French influence also waning a little bit.
Yeah, I'm glad you mentioned the Chinese, because I wanted to ask how close of a parallel it is to the Belt and Road Initiative.
In many ways, the UAE is kind of doing its own thing with trying to kind of maximize the advantage that it brings through its private sector and public sector. So while you see government companies like Masdar go on the energy side and DP World on the port side, you see that a lot of the private sector kind of move in lockstep with the government in according to areas where they see they can add an advantage to. One of the things they and a businessman mentioned to me, well, we do deal with the Chinese a lot there, but in many ways they define the areas that they want to excel at or they want to develop at, and they're moving in that direction.
OK, it's really fascinating reporting. Thank you to both of you, Bloomberg's Zainab Fattah and Ondira Oganga. We've got plenty more still ahead, so stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Lizzie Burden in Dubai. Let's bring you some of the other stories that's on our agenda this morning. Tencent is looking to expand its cloud business in Saudi Arabia and the UAE, betting that developing industries, including artificial intelligence, will require huge new investments in data storage. China's largest internet company says its investments in the region are at a nascent stage, but set to pick up quickly. Competitors, including Amazon Web Services and Alibaba, have been ramping up spending in Saudi in recent years. Elsewhere in corporate news, Nike shares tumbled in after-hours trading in New York after it posted a disappointing sales forecast. The world's largest sportswear retailer expects revenue in the first half of the next fiscal year to be down low in single digits. This comes as Nike shifts its sneaker offerings to improve performance across different categories. In other news, a senior US official says Chinese chipmaker SMIC may have potentially broken American law if it manufactured a processor for sanctioned telecom giant Huawei. The Undersecretary of Commerce for Industry made the remark during a testimony before US lawmakers. Washington has been investigating the advanced 7-nanometer processor that SMIC made for Huawei's smartphone last year. And now Reddit shares soared 48% in its trading debut as investors embraced the social media platform's vision for the profiting from the growth of AI. The COO, Jen Wong, spoke to Bloomberg from the floor of the New York Stock Exchange. Take a listen.
One of the things that's so special about Reddit is that we play in 3 big addressable markets. We have this core advertising business. Ads is a great business. It's still early. We have great traction and momentum. That's our core business. We have an emerging data licensing business that we built the foundations for last year because Reddit's corpus of information is incredibly important to the training of large language models and also for insights for different kinds of businesses. And the third is a user economy where our communities go beyond conversation into being able to transact with each other. Now, you asked about the data licensing business, which we built the foundations for last year. That has 2 pieces to it. It is a piece that's sort of well established, where there's social listening for marketing for companies who want to understand what's happening on Reddit to inform marketing campaigns. There's also financial services companies who are interested in that. Those are well-established markets. And then there's the new emerging market of AI, where large language models need data to train on. And when you look at Reddit's corpus, 19 years of human experience organized by topic with moderation and relevance, that's incredibly important to building both a chat capability and the freshness of information. So that's an area where we see opportunity. I think what that signals, whether it shows up honestly in our revenue or whether it shows up in the value of Reddit, is how valuable Reddit is. The more that we move toward this AI world, that corpus and that knowledge and refreshment of human experience becomes more valuable.
To our TV and radio audience, we are speaking with Reddit Chief Operating Officer Jen Wong. And to that ongoing value of your data to AI and to the large language models being developed, I mean, those LLMs, the models, are being built in new and different ways. This actual technology also develops. I'm interested as to really whether this goes on in perpetuity. Do you see this sort of licensing being steady and secure for 10 years from now?
What I'd say is this is so early in this emergence of this technology. It's hard to see far out. The way I think about it, the way we think about it is the Reddit's corpus of data is incredibly valuable, and it gets more valuable because as there's more content that's generated maybe by AI or computers, original human thoughts and ideas increase in value, right? If you think about it, a new car comes out. Who's going to review it? A real-life family of 6 can actually tell you what it's like to drive that car. That's always going to be valuable. And so, whether that shows up in data licensing or in the products that Reddit builds, it is valuable.
So that was the Reddit COO speaking to Bloomberg's Ed Ludlow and Caroline Hyde. The shares 48% above their IPO price, really the 4th biggest IPO on a US exchange this year, firing the starting gun perhaps on more tech IPOs this year. Although, if AI is at the heart of all this, I'm not really sure that the content on Reddit is the sort of thing I'd want feeding an AI brain. I spent a lot of time on Reddit as a university student, but there you are. If you think about it in a finance context, this is the platform, of course, that fueled the meme stock frenzy. But as you heard there, the Reddit argument is that human thoughts and ideas are more valuable as this content becomes generated by AI. So we'll stay across the Reddit story for you. We've got plenty more still ahead. This is Bloomberg Daybreak, Middle East and Africa. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Lizzie Burden in Dubai. Staying on China, and BMW is forecasting slower growth there as a sluggish economy and an EV price war weigh on the industry. BMW's shares slipped after its latest earnings showed a miss on cash flow.
We had a solid growth here of more than 6% on the combustion engine side, but even more so on the pure electric side. And we had that growth despite headwinds, which already existed last year. And we had growth, but at the same time, we have a record EBIT in 23. So what we always said, we want to grow, we want to profitably grow, and that is what we achieved in 23. And with that, with that wind, we will continue growth in 24, what we announced this morning. We will see slight growth on the BEV side, stronger than on the combustion engine side, but combined with the main regions, United States, Northern America, Europe, and China. And we will see growth specifically on the BEV side. That sentiment we see that people don't want BEV, we don't see that, especially when you look at 24, January, February. We're quite optimistic, especially about the BEVs and the upper premium segment.
And that's what I was going to ask you. What are you seeing so far in the first quarter as a sort of harbinger for what we can expect for this year to come? Where are the strongest markets right now?
When you look, for example, for the United States, alone the BEVs grew by 100% in January, February. We had growth on the BEV side, 40% in Europe and about 20% in China. So all regions are growing. We don't see any shrinkages. We see in some regions less growth, but that doesn't mean that we are shrinking. That's something completely different. So we see growth in all regions. On the ICE side, but also, of course, on the electric side in January, February. And now we have to see, you know, what's happening in March and then in the second quarter. It's still early times, but currently we are quite optimistic that over the year we will achieve growth.
And I want to ask you a little bit about the material costs. This is something else we're hearing from auto executives, that is rising. Where in your supply chain are you feeling that the most?
Well, we had a peak on the cost of supply chain, especially on the battery side, mid-23. But this is coming down rapidly, you know, and that also has to do that market sentiment is a little bit lower. But that doesn't mean that growth is not there. It's just less growth, and that has a price effect. So I'm not so much worried about the battery costs on the raw material side anymore. And of course, with product substance rising, materials costs will rise. And up to now, we were quite capable and putting that into a pricing mechanism. And raw materials, you know, they go up and down. Currently, they're going down. They're not going up anymore. So I think we have a realistic view on the developments, and we still can make a business case out of it.
So that was the BMW CEO, Oliver Zipse, speaking with another Oliver, Bloomberg's Oliver Crook, there in front of a very shiny BMW, I must say. But I also just want to get a check-in on Apple, because you did see a hit to the shares yesterday. This on the news of regulatory probes from both sides of the Atlantic. Bad news for Apple, also for Meta. Its proposal to charge a monthly subscription fee for accessing ad-free Facebook could come into future scrutiny under these same EU powers. hours. But as I say, you saw the Apple shares closing down, and there's a really great piece that I'd recommend to you on the terminal from Bloomberg opinion columnist Dave Lee. He argues that the US shouldn't be forcing Apple to make a worse iPhone by hamstringing it here, levelling the playing field, he says, makes it more complicated. It adds friction and insecurity to a device whose success is really based on getting rid of those sorts of things. So you saw Apple shares down, but it didn't stop the S&P hitting a fresh record high yesterday, the 20th of the year so far, and you've got US futures pointing to an even higher opening this morning. We're going to continue our markets discussion in the next hour of Bloomberg Daybreak Middle East and Africa. Jennifer Sabasaja will join me next from Johannesburg. Stay with us for that. This is Bloomberg.
This is Bloomberg Daybreak Middle East and Africa, our top stories this morning. The U.S. stocks party rolls on. The S&P 500 and NASDAQ 100 hitting fresh highs on hopes for a soft landing and after a surprise rate cut in Switzerland. Stocks in Asia broadly retreating today.
A top Israeli official says the military will invade Rafah in Gaza, no matter what the U.S. says. This ahead of a delegation to Washington next week.
Plus, with the UAE now the world's biggest foreign investor in Africa, we're going to discuss what it means for the continent and also for the Middle East. It is just past 9 a.m. across the Emirates, 7 a.m. here in Johannesburg. I'm Jennifer Zabasaja. Happy Friday to you, Lizzie.
Happy Friday to you, Jen. I'm Lizzie Burden in Dubai. It's sad for me, Jen. It's my last day here in Dubai, so I've come on brand. I've dressed as Emirates cabin crew for you. It's been a busy couple of weeks, hasn't it, in global markets? We've had that raft of central bank decisions this week, and you had the S&P actually hitting a fresh new record, the 20th of the year yesterday. But the risk-on mood isn't continuing into the session this morning. Let me take you through the equity picture. You've got the MSCI Asia Pacific Index down 0.7%. Japanese equities managing to eke out some gains, it should be said, given that you've had that hot CPI print out of Tokyo. But Avril Hong will get to that for us in a moment. European futures pointing to a lower opening, and stateside, not so much optimism for today's session, flat to the upside there. Why? Well, let me take you to the cross-asset picture. Let's flip the board over. What's happened is, yes, you had 3 rate cuts confirmed by the Fed in the dot plot for this year, but then we had economic data out of the US yesterday pointing to resilience in the US economy. And the question markets are asking is that going to mean that rates fall more slowly than they expect? You can see the doubts creeping back in here. The 2-year yield now at 4.61% because that resilience in the economy weighed on treasuries yesterday. The upwards pressure on yields lifted the dollar and now higher 0.2%. Just a quick look at Brent as well. $85 a barrel is where we trade, 0.7% lower. It's the second day down, really because of the geopolitical situation. When I got here, Jen, there were hopes for a ceasefire to mark Ramadan. We still haven't got one. What are you watching?
Yeah, we'll have to pay attention to what happens next there, Lizzie. Listen, if we take a look at the Turkish lira, there's an interesting story playing out because on Thursday we saw a surprise rate hike from Turkey's central bank. That really helping to strengthen the lira. The spot price is up just a bit this morning. But what's important to note is that the currency had been under pressure heading into local elections, which are happening at the end of March. And it had been weakening against the USD every week since August. But clearly this unexpected decision, unexpected for the markets, helping to reverse the sell-off in the lira and saw it strengthen against the dollar. We are hearing from Peter Kinsella, who is the global head of FX strategy at UBP, noting that clearly the central bank is determined to stabilize the currency there, even as inflation still exceeds 70%. Also, Lizzie, I want to take a quick check at Bitcoin because we have been paying close attention to the cryptocurrency. Definitely seeing a bit of downside, and this is a surprise, especially especially after weeks of a buying frenzy. If we take a look at where Bitcoin is trading right now, it's about 66,000, just over $236. But really the story here is that it's cooled off a bit, and clearly that's coming as ETF demand cools a bit, and also we saw recently approved U.S. funds start seeing net outflows, which is a different story for Bitcoin than we've been talking about for the past few weeks. Let's pivot though and talk and see how markets in Asia are faring. Avril Hong is in our Singapore studio. Hey, Avril.
Hey, Jen. Yeah, we're seeing central bank action as well as data really throwing a spanner in the works this last trading day of the week. A gauge of stocks in the region, which was yesterday just hovering at the highest level in about 2 years, turning tail today. And if you look around, there are plenty of mood killers, whether you talk about geopolitics, the Chinese chipmaker SMIC, reportedly, according to a U.S. official, breaking American law. And then you have next week, as investors brace for some of the earnings scorecards from the massive Chinese developers that are also those that are distressed, Vanke, Country Garden, there's really not a lot of appetite for risk. Long4 reporting already missing estimates. So CSI 300 Hang Seng today declining by the most since January. We're seeing the Hang Seng Tech really taking a beating today. The Nikkei, the outlier, on the back of relatively cheap yen still. But let's take a look at what we're seeing on the renminbi, because today we got an upset from the PBOC in a way, not from a rate decision, but from a yuan fix that perhaps signaled to the market that they're okay with letting the Chinese currency weaken as the economy slows, and traders were not positioned for that. So we saw offshore, onshore, both at the weakest level in about 4 months. And this is a lot for investors to digest. It's a bit of central bank indigestion, guys.
It's a good job we've got a weekend to digest it. Avril Hong in Singapore, thanks for that. And I want to say on central banks, because we've had a lot of surprises, haven't we, Jen, over the past 24 hours. We had that surprise quarter-point cut from the SNB, Bank of Mexico delivering its first quarter-point cut this cycle, Turkey and Taiwan surprising us with that 500 basis point and 12.5 basis point hike, respectively. Oh, my head spins. Let's get you some analysis. Jill Deesis joins us now. Jill, how much of a theme is this central bank divergence going to be going forward?
Yeah, so look, Lizzie, I think there are two major takeaways that we can really glean from all of these different decisions this week. The first one here is really that on the whole, inflation is really not as much of a major global concern as it obviously used to be. I mean, you're seeing that telegraphed out of a lot of these decisions. Obviously, the Swiss bank went ahead and cut rates already. I know that there are at least some traders that started to price that in for as soon as this month when we started seeing some divergence in central bank policy. But, you know, in addition to that, you did get some fairly favorable messaging out of the Fed, of course. You saw, even though they're obviously standing pat on rates for now, you know, Powell kind of dismissing some of that heightened CPI prints for January and February. You're seeing, you know, some room essentially for the Bank of England, ECB, to eventually start cutting rates in the future. So on the whole, inflation is just really, really not keeping central bankers up at night the way it was in 2021, 2022, 2023. I think that's really kind of theme one here. The second one is that, yes, we're starting to see that divergence in central bank policy as you're seeing some of these central banks start to pay a lot more attention to what's happening domestically and what that ultimately means for how they can individually shape their decisions. Obviously, the Swiss central bank went ahead and made their first interest rate cut, kind of running ahead of the pack there. But then you're also obviously, as you pointed out, with Turkey, with Taiwan, you're seeing sort of these sort of one-off situations where you've got these unique domestic challenges that make them kind of make their own decisions, and and so you're going to see less of a unified pattern across the world of everybody sort of making the same sort of cuts and hikes at the same time.
All right, Bloomberg's Jill Deesis, we thank you for that. Taking us through a busy week in central banks, which we can now analyse even further. Majid Dola, Equity Portfolio Manager at FAB Global Markets, joins us now. I wonder, Majid, if FAB is going to apply to your view for the equity markets. Are you feeling lucky?
Yeah.
Right?
The market at all-time high, yeah.
SocGen's raised its year-end forecast to 5,500 to end the year for the S&P. Okay. Can you take it higher for us this morning?
Well, I mean, we don't have a forecast for the S&P, and to be fair, having a number on the S&P is just, I think it's irrelevant to how you trade. Overall, if you look at the market, like you mentioned, all-time high, things looks very rosy, and we have this tendency this year, obviously, as the reporter just mentioned, for all central banks to dismiss inflation risk and focus on the next move for rates, which is obviously it's cut, and that's what the market right now focusing on. So it's market laser focus on interest rate cuts, dismissing all other risk that around geopolitics, around oil, around other things that might disrupt this rally.
Majid, we just walked through the week that was in central bank activity globally. I wonder, you and your team, I mean, how are you sort of taking it the next step further in terms of relevance to how you're trading? What is it that you're fixating on now that we have gotten so much central bank discussion about sort of the direction of travel for rate cuts?
Sure, that's a great question. So on the medium term, we continue to be bullish in the market. We believe the drivers that took the S&P to where it is right now, and the Nasdaq continue to be intact. You have the government spending, and we are in an election year. That's not going to stop. You have consumer that's continued to spend, and you have the labor market that's continued to be resilient in the U.S. And I'm talking about specifically the United States economy, because outside the U.S. things are different, and that's why central banks across the world should start to act a little bit more independently and focus on their domestic policy rather than just following what the Fed is doing. So that's on the medium term. However, tactically, we see the market that, I was here a few weeks ago and a month ago, and I think in December as well, and I was happy with being bullish in the market, and that was obviously the case. However, now things start to be a little bit, at the top, and I think taking some profit here would be very wise.
Okay, that's interesting, an inflection point. I'm interested that you mentioned the situation outside of the US. Europe, are you worried about concentration risk there?
Absolutely. I mean, if you look at the economy in Europe, and that's a big question that we should ask, why central bank cutting rates? I mean, in the US, central banks or the Fed is cutting rate to adjust the rate policy and continue to drive economic activities. However, in Euro, last year was disaster. PMIs is below 50. Some people say they bottom and now it's start to pick up, but however, it's still contracting, and the cyclicality of the European economy and the dependence of the Chinese economy as well make things more complicated for European investors, and obviously the Russian and Ukrainian war. So they got a lot of things going on for them, and that does not justify where equity market right now in Euro. The Euro 50 is up 12%. Year to date, and that drove by obviously by a handful of stocks, and that cannot continue. So in order to see this broadening, we need to see a pullback in Europe. We need to see some risk has been taken out of the table in the US as well, in order to continue for this healthy relationship between risk and return.
So then, Majid, if European equities warrant caution, I mean, what about Japanese equities? Because, of course, the BOJ made that big decision earlier in the week. Are you of the same mindset when you think about Japanese equities?
I mean, the BOJ, I don't see the rates hike, if we can call it hike, is the starting of a path for rate policy.
You think it's one and done?
I think so. I think it's going to take a lot for them to move again. However, if we look at the dollar and what we saw yesterday and what you just mentioned, the strength in the dollar, this will continue to be the case, given the resilience of the U.S. economy and given that we are going into more, inflationary environment post Biden presidency. If we assume that Trump will be, the president, that will continue to be favorable for dollar, and that will continue to drive maybe interest into Japanese equity.
And Trump's your working assumption?
Well, I mean, you got to do that. I mean, if you look at the bidding bidding website, you got around 65 to 70%, and it's a tail risk that you have to account for.
All right, Majid Dola, Equity Portfolio Manager at Fab Global Markets. Really good to have you on the programme on a Friday. You mentioned the changing geopolitical situation in Europe, and just an update, we've seen Russian missiles hitting several energy facilities across Ukraine as we've been having this conversation. We're going to pick up on the geopolitical news next. A top Israeli official says the nation's military will ultimately invade the southern Gaza city of Rafah. The latest on the war in the Middle East is coming up next. This is Bloomberg.
Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Jennifer Zabasadja in Johannesburg. A top Israeli official says his country is ultimately going to invade Rafah, no matter what the U.S. says. The defiant warning was sounded during U.S. Secretary of State Antony Blinken's visit to the region as he seeks a deal between Israel and Hamas.
There's a clear consensus around a number of shared priorities. First, the need for an immediate, sustained ceasefire with the release of hostages. Negotiators continue to work. The gaps are narrowing, and we're continuing to push for an agreement in Doha. There's still difficult work to get there, but I continue to believe it's possible.
For more on this, let's bring in Paul Wallace, our Middle East economy and government team leader. So, Paul, clearly the comments from the top Israeli official not going to go down well with the U.S., right?
Hi, Jen. Yes, I think that's right. Ron Dermer, who made those comments, he's Minister for Strategic Affairs in Israel, and perhaps of even more importance is he's pretty much Prime Minister Benjamin Netanyahu's closest political ally in the country. And he said in no uncertain terms that Israel will still send troops into the Gazan city of Rafah, even if the whole world is against it, including the United States. Now, he is actually going to Washington on Sunday. He and Israel's national security advisor are going to speak to U.S. officials specifically about Rafah. And it's unclear exactly what the Americans will say. There's a chance that the Americans try to persuade Israel against an assault on Rafah at all. They may decide to go for a middle ground and see if the Israelis are willing to accept a lighter assault. We obviously don't know in what form that would take. One thing is still clear, however, and that's that the US and both Israel are saying if anything does happen in Rafah in terms of the IDF going in, the civilians will have to have a chance to move out first. There are more than 1 million of them there. They pretty much all fled to Rafah around the time the war started in October. There's a huge amount of skepticism that anything like all of them can be moved out safely and quickly, and that's certainly something that the Americans will be pushing the Israelis on if the Israelis continue to insist that an offensive on Rafah must happen.
Yeah, because where are they going to go and how do you move them without Hamas embedding within them? Look, Paul, whether or not the US is prepared to use it, what leverage does it have over Israel to stop this movement into Rafah?
That is the big question, and a lot of skeptics of President Joe Biden's stance on the Israel-Hamas war, including many Americans, say that he simply has not used any leverage whatsoever. They say that America could say it's going to pull back on weapons supplies to Israel, that even if it doesn't pull back on defensive weapons, the Iron Dome missile interceptors, it could reduce the supply of offensive weapons to Israel or put conditions on their use. That would be a pretty big move, and there's no indication so far that the White House is considering that. It could use some diplomatic measures. For example, it could cease to abstain from any UN Security Council resolution that calls for an immediate ceasefire. So there are ways and means of putting Israel under more pressure, but it's not easy. Israel is absolutely adamant that this offensive on Rafah must go ahead. And there are also political considerations for Biden. Of course, he is being attacked by some people on the left in America for not being strong enough on Israel and putting enough pressure on it. But if he does go the other way and puts that pressure that they want on Israel, he will probably be attacked from the right. And of course, the November elections in the US are looming, and that's probably top of his mind with everything major he does right now.
Paul, at Bloomberg, we have an interesting story out about how reportedly China and Russia have struck some sort of deal with the Houthis to prevent the Houthis from attacking these ships in the Middle East, in the region. I mean, how much legitimacy is there to this? Is this really... I mean, give us a sense of sort of where we're at right now in terms of this conflict and the Houthis' role in it.
Well, we think this was significant. So this was an understanding. I'm not quite sure if you could call it a deal, but let's say an understanding struck between Chinese and Russian diplomats and a top Houthi leader in Oman in recent weeks. And it was essentially the Houthis saying that they would not attack Russian and Chinese ships in the Gulf of Aden and the southern Red Sea. The Houthis had already implied that, that was their stance, that they would give Russian and Chinese vessels safe passage. However, the fact that Russia and China went through the effort of holding these talks in Oman suggests that they are increasingly worried about the Houthi attacks, and that even if the Houthis don't target them specifically, there's always the danger that the Houthis make a mistake. So they probably ask for reassurances as well that the Houthis are doing everything possible and to identify ships properly to make sure that they don't attack a vessel that they don't realize is Chinese or Russian. But it also goes to show that the Houthi attacks are probably here to stay for many more months. There's very little sign that they are going to end imminently, despite the US and UK striking their positions on a pretty regular basis.
Yeah, and then you have to wonder about the power of Iran to disrupt Western trade in the area. Paul Wallace, our Middle East economy and government team leader, great to have you with us. Thank you. We'll have plenty more still ahead, so stay with us. This is Bloomberg.
Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Apple shares slid 4% yesterday, erasing more than $110 billion in market value after the U.S. Justice Department laid out their antitrust case against the iPhone maker.
We allege that Apple has employed a strategy that relies on exclusionary, anti-competitive conduct that hurts both consumers and developers. For consumers, that has meant fewer choices, higher prices and fees, lower quality smartphones, apps, and accessories, and less innovation from Apple and its competitors.
But big tech's headaches don't stop on that side of the Atlantic. Bloomberg's also learned that Apple, along with Alphabet's Google, is set to face a full-blown EU investigation into compliance with a new law reining in the power of big tech. We understand the European Commission is set to announce probes into App Store rules under its Digital Markets Act in the coming days. The move could pave the way for potentially hefty fines. So, big headaches there on both sides of the Atlantic. As I say, for Apple, the shares closing down more than 4% yesterday, Jen. You've got to ask, at what point does this downpour of cases and scrutiny become a real drag on how these companies operate? But there's an interesting piece on the terminal out from our opinion columnist Dave Lee on this. He says the US shouldn't force Apple to make a worse iPhone. So let's see how that case plays out. We'll have plenty more ahead as futures point to a slightly higher opening stateside. This is Bloomberg.
This is Bloomberg Daybreak Middle East and Africa. Our top stories this morning. The U.S. stocks party rolls on. The S&P 500 and NASDAQ 100 hitting fresh highs on hopes for a soft landing and after a surprise rate cut in Switzerland. Stocks in Asia broadly retreating today.
A top Israeli official says the military will invade Rafah in Gaza no matter what the U.S. says. This ahead of a delegation to Washington next week.
Plus, with the UAE now the world's biggest foreign investor in Africa, we're going to discuss what it means for the continent and also for the Middle East. It is just past 9:30 a.m. across the Emirates, 7:30 a.m. here in Johannesburg. I'm Jennifer Zabasaja.
And I'm Lizzie Burden in Dubai. Happy Friday, although I'm a bit sad, Jen, because it's our last show together from me in Dubai. But we have had a busy time, haven't we? We've had all of those central bank decisions, and you had the S&P hitting another fresh record for the 20th time this year yesterday. So let's take a look at how equities are faring this morning. Not so risk-on today, it has to be said. The MSCI Asia Pacific Index lower at 0.5% now, although some green shoots in Japan, and Avril Hong will tell you about those in a moment. But European futures pointing to a lower opening today, maybe a bit of upside to be had from Wall Street. But let me tell you why the confidence has been knocked. Let's flip over to the cross-asset picture, and you can see the hit to yields. What you had, to treasuries, I should say, what you had yesterday was all of this optimism about Fed cuts that was confirmed in the dot plot actually taking a knock because of the US economic data, undermining the narrative somewhat. Could the resilience in the economy mean that rates fall more slowly than the markets expect? This is what you can see here, the doubts creeping back in. It weighed on treasuries yesterday, and now you've got the two-year yield at 4.6%. The upwards pressure on yields lifted the dollar. And also, Jen, of course, it's been very, very busy for geopolitics while I've been with you. We had the hopes of a ceasefire deal coming in time for Ramadan. It didn't come. And now the geopolitical tension rumbles on. And then you've got Brent there, $85 a barrel, weaker, 0.7% down for a second day as traders digest that situation in Gaza.
Yeah, that's right, Lizzie. Look, adding to the week that was and the weeks that we've had you on is the surprise rate hike from Turkey's central bank on Thursday. What it actually did was help strengthen the lira, which is pretty interesting right now. It is marginally higher this morning, but the currency had really been under pressure heading into local elections, which are happening at the end of March, and had actually weakened against the USD every week since August. But that unexpected decision on Thursday helped reverse a sell-off in the lira and actually saw it strengthen against the dollar and still seeing some upside right now. What we're hearing from Peter Kinsella, he's the global head of FX strategy at UBP. He says that clearly the extremely aggressive move underscores the central bank's determination to stabilize the currency. But still, we're seeing inflation in the country above 70%. I also want to take a look at what's happening with Bitcoin. We've been speaking about it so much over the past few weeks. And right now we're seeing it at just over $66,000 right now. And the interesting thing here is we've seen weeks of buying frenzy, but actually the crypto is set to close the week lower. And what we're seeing right now, its peak, it's currently trading down. I mentioned 66,000 and its peak last week of nearly 74,000. So definitely pulling back a bit. And we're also seeing this happening as ETF demand cools and also the recently approved U.S. funds starting to see some net outflows, which is surprising, especially considering the past few weeks. But that's just a look at two assets there. Let's pivot, though, to markets in Asia and see how they're faring. Avril Hong, of course, is standing by in our Singapore studio. Hey, Avril.
Hey, Jen. Yeah, we're seeing a lot of selling going on in this part of the world as well. And the risks abound, whether you're talking about central banks, earnings to come next week from Chinese developers, as well as the geopolitics of it all. So the Hang Seng Tech is taking a beating today, but where we're really seeing declines are on the onshore yuan that's breached the 720 level against the greenback. Onshore, offshore, both at the weakest level since the U.S. USD against the USD in about 4 months. And this is going to have implications for other Asian currencies, for the Korean won and the Thai baht, for example, that are today leading the declines against the greenback. Some of it is a dollar story, but note here how they are sensitive to the onshore yuan weakness. That's going to have implications. And MLife strategist Mary Nicola points out that they are actually more sensitive to the yuan weakness than the dollar index. If you take a look at the 10-day beta rolling, let's take a look as well at what we're seeing on the Japanese currency, because of course it's been a big week for the BOJ. It's still hovering today above the 151.5 level. We did get some data out of Japan. Maybe that could prompt traders to price in another hike from the central bank later in the year. All things considered, it's really been about central banks this week, guys.
Avril Hong, we thank you for that update. That's dollar yen right now. But of course, as you say, we started the week with an end to an era. The BOJ's move to scrap the world's last negative interest rate signals confidence that economic stagnation is ending. And our Bloomberg Originals correspondent Kurumi Mori has been taking a look back at Japan's money experiment.
Imagine a place where everything money-related is frozen in time for almost 3 decades.
Your salary doesn't budge, the price of your unagi bowl doesn't change, and the interest rate on your home mortgage is closer to 0. Well, that was the reality here in Japan. We were used to the price of everything staying pretty much the same.
When you compare us to other countries, it's like we've been left behind.
But it wasn't always like this. At one point, the economy was growing so fast that it looked like it was about to overtake the US as the world's biggest. Then, the bust came. In the first of its shock moves, the BOJ sharply raised interest rates in 1989, trying to curb speculation and rein in inflation. From there, stagnation became the new norm. Japan has been ground zero for some of the biggest experiments in economics, from moving interest rates up and down to inventing the YCC monetary policy, among others. Now, Japan's central bank has decided it's time to end these experiments and exit negative interest rates. Raising the interest rate from negative 0.1% to a range of 0 to 0.1% doesn't seem like much, but it does put Japan back in line with other economies. If Japan's negative rates experiment ends, what now? And how is this massive shift going to disrupt everyday lives across the country and beyond?
And you can watch the full documentary on the terminal and on our website, Bloomberg.com. It's also on our YouTube and official social media pages there. All right, let's pivot back to the region. The UAE's investment pledges in Africa have exceeded all other countries over the last 2 years as they strive to outdo established players like China and France. But that's coming as the Gulf nation pursues geopolitical clout across the continent. For more, let's dig into this with Bloomberg's Zainab Fatah, who is joining us in studio in Dubai, and also Ndiro Oganga joining us from Kigali. So, Ndiro, let's just start with you. Can you just walk us through the investment in Africa that we're seeing from the UAE? And also, it's very interesting, this political and economic influence that's coming in addition to this investment.
Jen, let's begin from the most recent event where the UAE swooped in to literally save Egypt that was on the brink of collapse, injecting $35 billion in that economy. And to contextualize that money, it's 11 times what Egypt was seeking from the IMF, and it represents 7% of UAE's annual economic output. And the UAE says that should a similar situation arise in a different African country, they're willing to come in and help. And we've seen them do this in Ethiopia and Sudan, and they've also signed investment treaties since 2019 with countries like Zambia, Zimbabwe, and DRC. Very interesting that you mentioned politics, because we saw them back, Ethiopia's Prime Minister Abiy Ahmed, when the country was fighting Tigrayan rebels, and the UN is also saying that the UAE is involved in Sudan with RSF, an allegation that they deny. In terms of investment, we're seeing UAE-based companies look at developing countries in Africa where the economy is rapidly growing, infrastructure expanding. This strokes an energy demand. These countries include Kenya, South Africa, Egypt, and Morocco, where they've signed free trade agreements.
And Zainab, let me bring you in here. Which sectors is the UAE throwing money at in Africa, taking a punt on them?
Well, the UAE is looking at sectors it deems very important to it. So one of those is mining, and that includes, of course, mining for minerals that are going to be super essential to the green energy transitions, cobalt, copper, and lithium. Of course, logistics and trade, and that utilizes the ports that Dubai has in about 11 countries or so across Africa to create networks where the UAE becomes an indispensable player in this whole trade network across the world through Dubai, as well as make use of its trade hubs here, including DMCC, which is an important hub for trading commodities like gold and so on. So the UAE is looking at infrastructure investments, at energy transition, at mining, at real estate, also agriculture for its own food security. It's a desert country, doesn't grow very much, so they go into Africa and other countries, buy land, and that's important for their own country and securing its food resources.
Andiro, I mean, how does the UAE's investment compare with what we've seen from China and the U.S.? Because we talk about this a lot and really how China really poured a lot of money in for years. The U.S. is also trying to do it now. I mean, walk us through sort of where the UAE compares to those countries.
That's a good question, because just to pick up from where Zainab left, if you look at the areas of interest for UAE in Africa, they're capital-intensive areas, and that explains why they top the FDI ranking chart. In 2022, they pledged nearly $55 billion, and this went into putting them ahead of China 20 times and also ahead of America nearly 7 times. In 2023, this investment fell to about $44 billion, but still twice what China did. And like you mentioned, China is easing its investment on the continent because of late they are marred with bad debt. And Angola and Ethiopia are leading that pack. So we are seeing China pivot from previous infrastructure projects. They're looking at green energy, lending to countries that are not heavily indebted to them. America is also dipping their toe in investing in Africa. They're going the infrastructure route, with the Lobito Corridor being their flagship project in Zambia.
So the UAE kind of leaving China in the dust when it comes to the investing leaderboard, Zainab. How does it compare qualitatively to the Belt and Road Initiative?
In many ways, the UAE is kind of playing to its own tune. It's in this sense, they have come up with a plan around 2019 to create these special free trade accords with certain countries that they selected, including Turkey and Indonesia, but also a lot of countries in Africa, where they feel like their location, their proximity will give them an advantage and enable their own sectors also to advance and develop. So in that sense, they are working with Chinese companies. One of the businessmen I interviewed for this story told me that they deal a lot with Chinese companies that need energy. So his company comes in and is contracted by them to provide energy for mines and so on. But at the same time, it seems that this is mostly coordinated by the UAE government in areas where the policymakers decide how it is. And then they invite the UAE's private sector, including MEA and other companies, to come in and kind of move in lockstep with the government to achieve those goals. In many ways, for the UAE, this is a way to position itself as a gateway to Africa. So if you're any country you're trying to get into Africa, it's easy for you to do it through the UAE networks. Also, I mean, you ship through UAE ports, and you can travel on Emirates to a lot of these cities. So it gives a whole suite of benefit to this country.
It definitely has become a hub for the continent. Bloomberg, Zainab Fattah, and also Andiro Ganga, really great reporting. And as Zainab mentioned, you should definitely read her story along with our colleagues about this if you want to learn a little bit more. All right, let's move to South Africa. The former chief executive of scandal-ridden retailer Steinhoff International, Marcus Jooste, has died at age 63. Police in the seaside community about 120 kilometers south of Cape Town, where he reportedly lived, confirmed the death of a man without identifying him by name from a fatal gunshot wound to the head. His death comes a day after South Africa's financial regulator levied a $25 million fine against him for making and publishing false, misleading, or deceptive statements about the company. All right, stick with us. There is plenty more still ahead. This is Bloomberg.
Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Lizzie Burden in Dubai. Let's get back to some Middle East markets news now. Abu Dhabi's largest listed company is looking to float a holding firm worth about $27 billion next year. For all the details, we've got our equities reporter Farah El Barawi with us. And Farah, you've been speaking to the CEO of this company. What data, what details have you managed to extract from him?
Good morning, Lizzie. Well, this is would be rather significant for the Abu Dhabi Stock Exchange. This is a 100 billion dirhams company, or at least north of that. In fact, according to the CEO who I interviewed earlier this week, that firm is called 2.0. It was created earlier this year as a holding company, folding in companies from Abu Dhabi's Royal Group. These firms span sectors including financials, mining, and that should be coming to the market next year, according to the CEO. This would increase Sheikh Mahnoun bin Zayed Al Nahyan's presence on the stock exchange, where he's already linked to more than 2/3 of the stock exchange in terms of the weightings of these companies on the main benchmark. So we'll see how that will proceed. But also he said that International Technology Holding, as well as Sirius, which is two of their other units, are also on the table for IPOs. So a lot of activity from IHC, but they tend to sell more towards local demand. So we'll see how foreign investors fit in as well.
Farah, there's also a lot of attention being paid to a potential Lulu IPO, which is a Mideast grocer. What do we know about this? How close are we to actually seeing this come to fruition?
Well, Bloomberg did report that Lulu has actually hired several banks, including ADCB, Emirates NBD Capital, Citigroup, and HSBC for a potential listing, and it could raise as much as $2 billion. Bloomberg earlier reported that this could be in the second half of this year, and it's actually weighing a dual listing with Riyadh as well as the UAE. We don't have details on the timing and the potential size of the firm just yet, but Bloomberg reported in 2020 that the company is valued at $20 billion at that time. And this will be one of the most high-profile listings in the Gulf this year if it does proceed in the second half, and it's an important one to watch out for.
And speaking of IPOs, yesterday you gave us a preview of the parking IPO. Dubai's, of course, public parking business seems to have been a roaring success.
Well, absolutely, up over 30% on the first day. Parkin had already seen massive demand for the listing, and those who didn't get the allocations that they wanted were definitely jumping in the secondary market, as we saw yesterday. More than 178 million shares traded, and the key here will be, will this momentum be sustained throughout the coming few days of this listing being open? The market will open in just 10 minutes. Parkin had a record demand, according to the company, for an IPO in Dubai. That's $71 billion. So a key one to watch out for just in 10 minutes on the market.
All right, Bloomberg's Farah El Barawi, we thank you for that update on Middle Eastern equities. Oh, we're in sync. 2 weeks, and what do you know? We just become harmony, Jen. Let's keep talking about IPOs because it has been a busy one. You've also had Reddit off to a cracking start. The shares soaring 48% above their IPO price. We weren't sure this was going to happen when we talked about it yesterday.
No, and it's really interesting. I mean, it made the IPO making a lot of money for initial investors and actually helped the company raise $748 million in the fourth largest U.S. IPO of the year. Of course, we're only in March, but there had been so much anticipation for this IPO. Wow, look at the mascot there on the stock exchange. I think definitely it's safe to say it was a good first day success for them.
Yeah, it kind of fires the starting gun for tech companies. Oh, it was really weird, that mascot, wasn't it? To get the IPO plans back off the ice and into action. Although there's a lot of excitement here about AI, I'm not sure that the content on Reddit is the sort of stuff I'd want to be feeding into an AI brain. But there you have it. The investors seem to think it's worthwhile content having. But we've got plenty more ahead. In other news, on corporate front, we've got S&P evening and NASDAQ futures pointing to a higher opening now. We'll tell you why. Coming up, this is Bloomberg.
Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. European Union President Ursula von der Leyen says there's strong support to send the money from frozen Russian assets to Ukraine. She said it could be dispersed as early as July 1st. Let's get more from Bloomberg's Oliver Crook, who is in Brussels for us. So, Oliver, what more do we know about these frozen Russian assets?
So this is arguably the most important point sitting in front of European leaders over the next couple, or I should say yesterday and today, what to do with these Russian frozen assets. Can they find consensus within EU and really specifically focus on the profits from them? So we know annually it's about 3 billion euros that could go to Ukrainian defense. There is some sort of momentum here, but there is still some disagreement about how that money could be used. Could it be towards military applications? Some member states are a little uncomfortable with that and would rather see it go to reconstruction. But we heard from von der Leyen that the first payment could come, if there is agreement, as early as July the 1st, and it could be 1 billion euros. What is also very interesting is this other idea that has been put forward by the United States, which I think will be very much talked about over the next couple of weeks and months, this idea of freedom bonds, which is, in sort of characteristic American fashion, the packaging of it, where you're trying to actually get as much as you can from the Russian assets. So you're going to basically package it up into a bond and say future profits from these assets we're going to pay now to Ukraine, and that could be up to $50 billion worth of it. So that is really their way of trying to front load and really maximize these Russian assets without touching the underlying assets, which again are about 260 billion euros. But touching those is a much more fraught issue. And if there's not agreement here, that is a much more difficult one to get into.
And meanwhile, Ollie, what are we hearing about talks for Bosnia's accession to the EU?
Yeah, so this is interesting because the EU, if you remember last time, the last member to join, it took 10 years for Croatia to get this going. And there's really a new urgency within the EU in sort of trying to battle for influence over a lot of these countries that are on the eastern flank of Europe between Russia and Europe. And so basically what they have been saying, and we heard this from leaders as they were coming in yesterday, that Bosnia has done a lot of work to try to align its values, some of its priorities with the European agenda, and evidently enough so to say that now the EU is willing to open negotiations and those talks about accession. What is interesting, you also have the same conversation going on about some other countries, Moldova, Ukraine. I spoke to the Ukrainian Prime Minister about this just 2 days ago. Is there potentially a gradual route into Europe and not full membership, which could accelerate the process?
All right, excellent reporting. Bloomberg's Oliver Crook in Brussels. We thank you for it. Tom McKenzie's up next with Daybreak Europe, so stay with us for that. This is Bloomberg.